Most dividend investors are paying 30 to 40% in unnecessary taxes on income that could be completely sheltered. Here's exactly how to collect recession-proof dividend income using HSA and 401k accounts. Strategies the wealthy have weaponized for decades while regular investors had no idea they existed. I'm going to show you the exact account structure, the specific stocks, and the sequencing strategy that lets you build taxable income with zero tax liability. Let's start with the uncomfortable truth. Dividend income is one of the most heavily taxed forms of earnings. Long-term capital gains? Taxed. Qualified dividends? Taxed. Unqualified dividends? Taxed at your ordinary income rate, potentially 37% federal plus state taxes. But here's what most people don't realize. There are 3 account types that can hold dividend stocks with zero annual tax consequences. Zero, not deferred, not reduced, actually zero. First, your HSA. Most people think the HSA is just for medical expenses. It's not. An HSA is actually the most powerful wealth-building tool in the tax code, and almost nobody uses it correctly. Here's why. You get a tax deduction going in. That's $4,150 for individuals, $8,300 for families in 2024. The money grows completely tax-free. You can withdraw it tax-free for qualified medical expenses. But, and this is the part everyone misses, after age 65, you can withdraw money for any reason, paying ordinary income tax only on non-medical withdrawals. That's literally a Roth IRA with a medical escape hatch. So here's the hack. Fund your HSA to the max. Invest it in dividend stocks or dividend ETFs. Don't touch it. Let it compound for 20 years. By retirement, you have $150,000 growing completely tax-free, generating dividend income with zero tax consequences, because it's sheltered inside the HSA wrapper. I want to pause here because this is critical. The HSA is not your emergency fund. You need a separate bank account for that. The HSA is a long-term wealth vehicle. Treat it like a brokerage account that happens to have incredible tax benefits. Now the second vehicle, your 401k. Most people max out their 401k, sure, but they're putting it in boring target date funds or money market accounts. They're not using it as a dividend-generating machine. Here's the strategy. Max your 401k contribution. $23,500 for 2024, $30,500 if you're over 50. Then immediately instruct your plan administrator to invest it in dividend-paying stocks or dividend ETFs. Every dollar of dividend income that stock generates is completely sheltered inside that 401k wrapper. You're getting paid dividends inside a tax-free container. The dividend reinvests automatically. You never pay tax on it until withdrawal, and by then you're potentially in a lower tax bracket. Let me show you the math on this. Say you invest $23,500 in a dividend stock that yields 4%. That's $940 in annual dividend income. Outside the 401k at a 37% tax rate plus state taxes, you'd owe roughly $365 in taxes immediately. Inside the 401k, zero taxes. That $940 compounds and stays invested. Over 25 years, that difference compounds to tens of thousands of dollars in avoided taxes. Third vehicle, the backdoor Roth IRA. If you're high income and can't contribute directly to a Roth, you contribute to a traditional IRA, then convert it. Same principle. Dividend income grows completely tax-free forever. Withdrawals in retirement? Tax-free. Now, which dividend stocks actually work for this strategy? You want recession-resistant dividend payers. These are companies that maintained or increased dividends during 2008, 2020, and 2022. We're talking utilities, NextEra Energy, Duke Energy, consumer staples, Procter & Gamble, Coca-Cola, healthcare, Johnson & Johnson, real estate investment trusts, Realty Income. These aren't sexy growth stocks, but inside a tax-advantaged account, you don't care about capital appreciation. You care about reliable, growing dividend income that survives recessions. Here's the pattern most people miss. When the market crashes, dividend yields spike because stock prices fall while dividends stay relatively stable. So a stock yielding 3% suddenly yields 5%. Inside your HSA or 401k, you don't panic sell. You let it compound. You're buying more shares at lower prices with your tax-free dividends. That's compounding on steroids. But there's a sequencing strategy that determines whether this actually works. Withdrawal sequencing. Here's what most people get wrong. In retirement, They withdraw from their regular brokerage account first, thinking they're preserving tax-advantaged accounts. Wrong. This is backwards. Correct sequencing. Draw from 401k first, you pay ordinary income tax, but you're pulling from the largest account. Then traditional IRA, then Roth IRA last, because Roth withdrawals are tax-free. Your taxable brokerage account sits untouched, compounding, because you've got long-term capital gains rates there anyway. This sequencing can save you tens of thousands in taxes over a 30-year retirement. Here's one more layer: tax loss harvesting inside your taxable accounts. You hold dividend stocks there too. When they dip, you sell at a loss. Harvest that loss against other gains, or up to $3,000 against ordinary income, then immediately buy a similar dividend stock. You've locked in a tax deduction and maintained your dividend exposure. Repeat this annually and you're generating thousands in tax losses. The complete strategy looks like this. Max your HSA, $4,150. Invest in dividend stocks. Let it compound 25 years untouched. Max your 401k, $23,500. Invest in recession-resistant dividend payers. Reinvest dividends. Max your backdoor Roth if eligible, $7,000. Same approach. Maintain a taxable brokerage account with similar dividend holdings. Harvest losses annually. Reinvest dividends. In retirement, draw from 401k first, then traditional IRA, then Roth, while your taxable account compounds. You're living almost entirely on tax-free or tax-deferred income. A high-income earner doing this could realistically save $3,000 to $8,000 annually in taxes, while building $500,000 plus in recession-proof dividend income over 25 years. Not through aggressive tax evasion, through perfectly legal account sequencing that most people don't know exists. The difference between knowing this and not knowing this: decades of unnecessary tax payments. If this strategy resonates with you, subscribe and hit that notification bell.